Welcome to the market recap. In today's video, we are going through what a dead cat bounce is and how you can trade it. A dead cat bounce is a term used in finance to describe a temporary and brief recovery of a declining stock price. It is based on the idea that even a dead cat will bounce if it falls from a great height. In other words, a dead cat bounce is a false signal that the downtrend is over and the stock price is ready to rebound. So what causes a dead cat bounce? It is usually caused by two types of investors: bargain hunters and short sellers. Bargain hunters are those who buy the stock at a low price, hoping that it has reached its bottom and will soon rise again. Short sellers are those who borrow the stock and sell it at a high price, betting that it will fall further and they can buy it back at a lower price. When the stock price drops significantly, short sellers may decide to cover their positions and lock in their profits, which means they have to buy back the stock. This creates a sudden increase in demand and pushes the price up temporarily. However, this increase in price does not last long, as the underlying fundamentals of the stock or the market are still weak. As soon as the bargain hunters and short sellers exit the market, the supply of the stock exceeds the demand again and the price resumes its downward trend. This is why a dead cat bounce is considered a continuation pattern, not a reversal pattern. But how can you identify a dead cat bounce? It is difficult to identify a dead cat bounce in real time, as it may look like a reversal of the downtrend. However, some technical and fundamental analysis tools can help you distinguish between a dead cat bounce and a genuine recovery. For example, you can use trend lines, moving averages, volume indicators, and earnings reports to analyze the price movement and the strength of the rally. Generally speaking, a dead cat bounce is characterized by a low volume, a weak momentum, and a short duration. To illustrate this concept, let's look at some examples of a dead cat bounce. Here is a chart of Enron's stock price from 2001. As you can see, Enron was one of the largest energy companies in the US until it collapsed due to accounting fraud and bankruptcy. During its decline, Enron experienced several dead cat bounces, where the price briefly rose before falling further. Notice how each bounce was lower than the previous one, indicating that the downtrend was still intact. Another example is Lehman Brothers' stock price from 2008. Lehman Brothers was one of the largest investment banks in the world until it failed during the global financial crisis. Similar to Enron, Lehman Brothers also had several dead cat bounces along its downfall. Again, you can see how each bounce was lower than the previous one, and how the volume was low during each rally. A more recent example is Bitcoin's price from 2018. Bitcoin is a cryptocurrency that reached its all-time high of nearly $20,000 in December 2017 before crashing to below $4,000 in November 2018. Along the way, Bitcoin had several dead cat bounces that fooled many investors into thinking that it was recovering. However, each bounce was followed by a lower low, confirming that the bear market was still in effect. So how can you trade a dead cat bounce? There are two main strategies, one for short-term traders and one for long-term investors. Short-term traders may try to profit from the small rally by buying low and selling high. However, this strategy requires precise timing and risk management, as you have to enter and exit the market quickly before the price reverses again. You also have to be careful not to confuse a dead cat bounce with a genuine recovery, as you may end up losing money if you sell too early or too late. Long-term investors may use the temporary reversal as an opportunity to initiate or add to a long position. This strategy involves buying more stock on the way up. However, this strategy also involves risks and challenges, such as finding liquidity to add to your position, support levels that indicate the stock will continue to move in a bullish direction and that the volume of the stock remains healthy. You may also choose to initiate a short position. This involves borrowing the stock and selling it at a high price during the bounce and buying it back at a lower price. However, this strategy has risks such as paying interests, margin calls, and being exposed to unlimited losses. Therefore, trading a dead cat bounce is not for everyone. It requires skill, experience, discipline, and patience. You also have to avoid emotional biases such as greed, fear, hope, and regret that may cloud your judgment and lead you to make irrational decisions. You may also want to employ the dollar cost averaging or buy the dip strategy, which we have covered in a previous video. Thanks for watching and have a nice day. Hit like, subscribe, and ring the bell for more content like this.